Last week, Alphabet Inc., best known as the parent company of Google, Android, Pixel, and YouTube, issued bonds worth $32 billion. Now, in and of itself, there's nothing unique about this. American technology giants, traditionally known for their cash-generating capabilities and their ability to command high valuations, have in fact been tapping the bond market as well for their funding needs for the last 10 to 15 years. However, Alphabet's last week's issuance is unique for two reasons. First, a small slice of this issuance, about 4% of this issuance at about $1.25 billion of bonds, actually carry a maturity of 100 years. That is, the investors in these bonds will be repaid in full only in 21-26. Second, this 100-year bond issuance has not been made in dollars, yen, or euro, which are the most liquid currencies in the global financial market, but has been made in the pound sterling. In this week's finance and governance column in ThePrint, I co-opted my friend Harshvardhan, and we both argued that Alphabet's last week's century bond issuance reinforces investors' confidence in the three most fiercely debated bets of our time. Number one, the adoption of artificial intelligence in the near future. Second, the ability of American technology companies to compete with DeepSeek-like open source models emerging in the near future. And third, shall we dare say, the long-term stability of the pound sterling. Century bonds are usually issued by nation states or by universities, basically institutions that are likely to be around for at least 100 years. But even for nation states, issuing century-long bonds is a very bold signal, and very few nation states have actually managed to do it successfully. For some perspective, the longest US government security bonds are for 30 years, and even the United Kingdom, which has one of the longer maturity curves amongst the developed countries, has issued what it calls very long-term bonds of 55 years. For private corporations, it is an even rarer feat to be able to issue such long-term bonds. The last time such long-term bonds were issued by private corporations was in the 1990s, which many might argue was a relatively more stable time than what we are living in today, both from a macroeconomic and a geopolitical perspective. In between 1993 and 1997, 5 corporations issued 100-year-old bonds, all denominated in USD. These were issued by IBM, Coca-Cola Company, Motorola, Walt Disney, and our very own Reliance Industries Limited. Even if we were to compare Alphabet Inc.'s last week issuance with these century bonds that were issued in the 1990s, Alphabet Inc.'s bonds stand out for 4 reasons. First, they offer a nominal coupon rate of about 6.12%, which is about 90 basis points over and above the US 30-year government securities yield, and about 120 basis points over and above the UK 50-year gilt bonds. In short, investors do not seem to have asked for a very high risk premium to subscribe to these 100-year-old bonds, even in today's relatively unstable times. Second, these bonds are relatively covenant light. Our discussions with market participants suggest that the bond issuance documents do not offer any minimum interest coverage ratio related requirements, nor do they offer any guarantees from Alphabet's cash-rich operating subsidiaries. Third, Alphabet seems to have taken some sort of a call option in the bond issuance document, which means that Alphabet can choose to repay these bonds earlier than 100 years, but investors do not have a put option, which means that investors cannot force Alphabet to repay these bonds earlier than 100 years. Perhaps most curious is Alphabet's choice of currency and jurisdiction. Like I mentioned earlier, Alphabet chose to issue these bonds in the pound sterling. Now, this may be a sign of cooling confidence in the long-term stability of the dollar. The dollar index, which popularly known as Dixie, which tracks the US dollar against 6 major global currencies and is generally an indicator of the confidence in the dollar, has dropped by about 10% in 2025, and it continues to drop. Central banks have also been weaning away from the dollar, and countries have been trying to get their foreign trade invoiced in other currencies as well. And that may explain the choice of making this small slice of the overall issuance in the pound sterling. But why the UK? Why did Alphabet choose to skip the liquid US dollar denominated bond market and instead choose UK as the jurisdiction for issuing these bonds? We argue that two things may explain it. The first one is that it is possible that Alphabet wanted to tap into the long-term investment appetite of UK pension funds and insurance companies. And second, it is possible that Alphabet wanted to diversify its funding options and signal that it is in a position to raise money from jurisdictions other than the United States, jurisdictions that may in fact take a more conservative approach towards AI compared to the United States. The successful placement by Alphabet of its century-long bonds has broader implications. World over, especially in the West, public balance sheets are under stress. The debt to GDP ratio has increased significantly, and it ranges anywhere between 103% for UK to about 200% for Japan, suggesting that investors are losing confidence on the sustainability of sovereign finance. Therefore, in a market that is usually reserved for such long-term issuers, the fact that Alphabet could issue Alphabet, a private corporation rated at AA+, could make a successful placement of a century-old bond, may suggest a more long-term shift in investor appetite for these long-term bonds. As we hurtle towards an AI-driven future, we must ask ourselves, are technology behemoths likely to replace sovereign nations as the world's most credible borrowers? For investors who invested in last week's Alphabet's century bond issuance, the answer seems clear. Last week's issuance suggests that Alphabet Inc. has in fact passed the hard bond market test. And now it is an open question whether in the future long-term investors are likely to shift their trust from debt-heavy public balance sheets to cash-rich balance sheets of technology companies.